Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of the Provident Fund, how it's taxed in the U.S., and if you have to report it. So what's a Provident Fund, right? In a lot of different countries, they have things called Provident Funds. In Hong Kong, you've got the MPF. In Malaysia, you got the EPF. In Singapore, you've got the CPF. Provident Fund is essentially sort of a hybrid of Social Security / 401k, generally grows tax-free in the country that it's in, and it's oftentimes required. So that's why it's sort of a hybrid, right? 401k, people are like, oh, it's a CPF, it's an MPF, it's the same as a 401k. Well, that's not entirely true, because you don't need to do anything for your 401k. You don't even need to have a 401k, right? Employer can't force you to do it. In a lot of these other countries, it's sort of more of a hybrid, like Social Security and 401k and IRA all kind of combined into one. Some of them have different parts to it. CPF, for example, has 3 different parts. Generally, you can't touch it until you're older, but it's a little different than just Social Security because there's normally a value to it, right? There's a balance based on how much you've worked, how much you've contributed, and once you reach the age or you're no longer a permanent resident or citizen of that country, or if forbid you became fully disabled, then you would be able to apply to get those benefits. So the big question we get is whether it's taxed in the U.S. And the answer is generally yes for most countries, because most countries there is no tax treaty. So here's an example. You've got Hong Kong, MPF, you've got Singapore, CPF, right? The U.S. doesn't have a tax treaty with either one of those countries. So, for example, like with the UK, there's a tax treaty if you're a U.S. person working in the UK and you're working for a UK employer and they're making contributions into your UK employer-borne pension, then generally you get the same benefits on your U.S. return that you would get if it was a 401k. So if they contribute, a certain amount of money, $10,000, you get to deduct that on your U.S. tax return, generally up to the amount you would be able to deduct for the U.S. equivalent. When you've got countries like Singapore and Hong Kong, Malaysia, when there's no tax treaty, there's no treaty that says you can do that. So then it's not considered in the U.S. as something that's tax deferred. You don't get to carry over that tax deferred status. So for the most part, contributions are taxable, and distributions are taxable as well. In fact, even the growth within it is taxable, right? Because essentially it's available, it's growing within there. It may not be available as in you've reached retirement age, but there is an amount and it's in there and it's vested, and so it's taxable in the US. I mean, that's kind of the baseline perspective. Some people, they write things like, oh, it's only the amount over your basis, which is true, but you got to be careful. Let's say you came to the US a while ago, you were not paying tax on the contributions being made, right? And you're not paying tax on the growth. Well, then what's your basis, right? You don't really have any basis for the time you were here and for the time you were receiving contributions in there and the growth, because you haven't paid any tax on it. So, if you're in that situation, you should speak with the board certified specialist and kind of get the lay of the land. Beyond just the tax portion, another major concern is the reporting. Technically, Provident Funds are like accounts, so you've got the FBAR form, Bank and Financial Account Reporting. You've got FATCA form 8938. You may have PFIC issues, foreign mutual funds and CCOVs and things like that, depending on the makeup of the investment. So at the end of the day, it's important to make sure that there's a tax consequence to it and there's a reporting consequence to it. Some people will come to us and say, hey, I've read online on the IRS's website that it says that retirement, like IRAs, are not reportable, accounts associated with that. There's a distinguishing factor, which is this. If you had an IRA, and within that IRA, let's say, which you don't control, right? You have an IRA company, and that company, the IRA has accounts or funds from outside the U.S. You generally don't have to report those as separate. You don't control them. The fund manager decides what goes in there, and it's not really something you have any control or dominion over, right? That's not the same thing. So from a baseline perspective, if you got a foreign Provident Fund, other types of pensions, SIPs, Australia superannuation, it's generally all reportable on the FBAR and Form 8938 and possibly the 8621. One thing to keep in mind is there is a tax treaty with Thailand, and so there is a Provident Fund with Thailand. You may be able to get tax deferred status on that, right? Because there's a treaty. The treaty basically says it's not taxable until it's distributed, and so until you start receiving distribution. So if you have one in Thailand, not as common, but if you do, it is tax deferred over there, and you may receive tax deferred status here until distributions are being made. If you're out of compliance for not properly reporting your Provident Funds in prior years, you want to consider getting into compliance. There's lots of different programs. There's the voluntary disclosure program. There's the streamlined procedures, streamlined domestic, streamlined foreign, reasonable cause and delinquency. We have tons of free information available on our websites. You can always reach out, schedule a reduced fee initial consultation with a specialist if you think it's appropriate. Again, my name is Sean Golding for Golding & Golding. Thank you for your time. Enjoy the rest of your day.